Hi there, thanks for tuning in. Today, we're going to be doing an analysis and valuation of Polaris Inc. Now, what's Polaris? Polaris is essentially a company that makes discretionary, off-road, some on-road, some marine, and some military vehicles. You can see, for example, the RZR, the Ranger, or some ATVs that they make. This is just taken from their main page and their website, but they do have other sectors. They do have a marine product that's a literal boat. They have an on-road product, a road legal vehicle, as well as a contract with the military, so they make a certain vehicle for the military as well. Polaris is a market leader in this segment. They have $8 billion in sales, roughly. Most of that is these off-road vehicles, some on-road vehicles, the aftermarket, the marine sector, and then this other segment, which I suppose is mostly the military stuff that they do. They mainly sell in the United States, but they do have a few international sales, and yeah, they seem to be a market share leader when it comes to power sports. If you live near the country and want to buy an ATV or a Ranger, you're probably looking at a lot of Polaris products there, you know? So Polaris definitely has a name there. They have some strong products that are easily recognizable. However, does this translate to a stock that we actually want to buy? Well, let's look at their financials. And knowing that 2020 is a very different year for Polaris, but as a consumer discretionary stock, because you have to choose to buy these things, you don't actually buy an ATV because you need one, right? Well, it was also benefited by the cash injections that the American consumer got in 2021, right? So these have been some weird years with Polaris, and in fact, the fact that they don't include 2019 numbers, although I do have them myself, is very interesting because that's probably a good benchmark with which to compare things instead of just comparing it with 2020 and even 2021 and 22, right? So estimating things is going to be a little tricky simply because of the nature of things, but we're going to do our best here. And as you see, sales have grown a whole lot, especially when compared to 2020, but ignoring that, sales have grown from 2021 to 2022. Most of the sales or of the revenue goes away with the cost of sales, right? I assume it's the cost of manufacturing vehicles. They do everything in-house, and that means that the cost of this is going to be significant for them. But that also means that their operating expenses in general are fairly low. They have not that many fixed costs in relative terms, and you'll see these are fixed costs because even in 2020, when production was down, when sales were down, they still had roughly the same costs here. And you can see that net income at the end of the day is roughly a little more than 5%, maybe towards 6% of the total sales. So that's their total net income margin, which makes sense. You can't expect double digits of net income margin for a company that actually manufactures the vehicles it sells, right? So that is that. It is a healthy margin, I would say. It's something that they can suffer a little bit of crunch, but their net income wouldn't go to negative necessarily. But inflation could affect this, right? So here's their guidance for 2023 from their latest quarterly investor presentation. They're essentially telling us that sales are going to be flat to up 5%. That is mainly going to be driven by growth in their off-road sector and on-road sector. And then we can see that their operating expenses may be a little flat to up 30 base points. We can see that their operating and adjusted free cash flow will be up significantly. We don't really know what this means, but this will be important when we calculate free cash flow, and their capital expenditures will be roughly $400 million. Okay, we can work with that. So I am going to spend very little time looking towards the investor presentation and more towards calculating the fair value of Polaris. So I'm going to estimate future sales, and I want them to be in line with what they're saying in their projections, which is flat to about a 5% growth. So I went to Yahoo Finance, and I went to the analysis tab for Polaris, and I see that there are analysts that have estimated revenue. I want to see revenue estimations rather than earnings estimations because those tend to be a little bit more accurate, especially when we get a healthy amount of analysts, like 14 here, and they give us an average, a low, and a high estimate. You could take the low number if you want to be conservative. I'm going to take this average number that is 8.77 billion in sales for next year, and then for 2024, 8.91 billion in sales. So I think that's reasonable. I think that's in line with sort of their low single digit growth. And with this average, we're hoping that we're somewhere in the ballpark. We don't need to be exactly there, but we're somewhere there. And to estimate free cash flow, this is going to be tricky because there's a lot of variance in free cash flow. For 2018, for example, they had a free cash flow of $251 million, which went up to $403 million, which went up in 2020, which we're not really going to pay attention to $814 million. Now in 2022, it's $202 million of free cash flow to equity, which is simply their cash flow from operations minus their capital expenditures. I'm going to take a long-term average of the free cash flow divided by the revenue, and it's going to give me a 5%, right? 5% of revenue gets turned to free cash flow. So I will be conservative in my forward-looking estimations by saying this rather than saying, okay, the free cash flow is going to be up significantly. Who knows what that'll be? But I'll just take this average that includes some low numbers here and some high numbers here and roll with it, right? And with this number, we can do a free cash flow to equity model. And here you'll see that these are simply 5% of the estimated revenues, which were those average sales from Yahoo Finance. And then I'm assigning it for 2025 and 2026 a growth rate of 3%. Then we have a perpetual growth rate of 2% and a required rate of return of 11%. If we get those numbers and divide them by the total number of shares outstanding, which is 56.9 million shares, we get a fair value of equity of $86.68. Now, if we add the net debt that they have and we subtract that from the total value, we would get a value of $53.45 per share. Now, where's Polaris nowadays? Well, it's trading at $105.67. This is pretty far from the price we had. But if you look, for example, at this metric, the PE ratio, it's 12 or almost 13, which generally is lower than historical averages, you would say. And if you look at the market cap of 6 billion and compare it to the sales of 8 billion, you'd see that it's also trading below sales. So what matters here is your perspective, right? I'm looking at free cash flow. I am maybe being conservative here, although I'm trying to stay somewhat in line with some realistic estimations. And what I'm getting is way off the price. However, if you're looking at just price to earnings and price to sales, you may be thinking this stock is quite undervalued, right? But if you see, their 5-year performance has been quite unremarkable, with the exception of those who bought during the dip in 2020. And if you did so, I'm sure you're incredibly happy with the performance of this stock. But otherwise, if you bought at any other point, you haven't seen significant gains other than maybe selling at this peak here in early 2021. So this is interesting because it just shows that Polaris does go through its peaks and troughs, but you have to pick your moment very, very well if you expect to make significant profit with this stock, right? So I think there's two scenarios here. One is that I'm understating the value of this stock, right? So it may have a much higher growth rate than I've projected. Perpetual growth rates can be adjusted upwards. My discounted cash flow model had a perpetual growth rate of 2%. It could be 3%, and that would adjust the value upwards. When looking at price to sales and price to earnings, it looks cheap at least. Is it cheap? I don't know. It does have a moat, despite being consumer cyclical. In the market for off-road vehicles, I feel like a lot of people would consider Polaris among their first options for snowmobiles, for ATVs, for off-road vehicles, for even some utility vehicles. And it does have relatively low fixed costs, which is fantastic, and they do have a dividend, and they do buy back shares. However, on the flip side, maybe we're understating the risk. It's a consumer cyclical company at the end of the day. It has outsized impact from economic downturns, supply chain issues, and recessions. You're going to stop buying ATVs and snowmobiles if you see yourself losing income. You're not going to stop buying food. So Polaris is going to be very affected by these things. Inflation can affect margins on production. Of course, the raw materials, the raw parts that they use may increase in price. And if Polaris can't pass all of that on to the consumer, their margins will see a crunch. Future free cash flow may not match sales growth depending on what their strategy is. Maybe a lot of this money will end up going towards paying down debt because their debt pile has been growing. Maybe they are issuing future debt for acquisitions. Well, depending on all that, free cash flow may look very different if they're opening new plants and capital expenditures go up. So future free cash flow is a little spotty to estimate, but that also means that there's the risk of free cash flow not being as high as we would want it, especially if we're doing a discounted cash flow model. And there's always the risk of recalls and inventory accumulations for companies like this. And they have faced recalls before, they may face them again eventually. Who knows, right? So that's where I have to ask, what's your risk profile? If you are willing to take on the risk of a consumer cyclical company, well, that's cool, but you have to buy it at the right price. And you have to accept that there's going to be a certain amount of risk. Maybe you have to put a certain amount of margin of safety, knowing that it is a company that is more vulnerable to macroeconomic trends rather than companies that are pretty insulated to that. So it just depends on your risk profile, whether Polaris makes sense for your personal portfolio or not. And that's something where I think it's important to focus on risk first. And then if you feel like the risk reward is appropriate for you, then you can start considering stocks like these. With that said, I hope you found this valuation useful. And if you have any questions about it, feel free to comment down below. With that said, that's all for me, and I hope you have a great rest of your day.